Well, to discuss Eurozone interest rates, the debt crisis and Portugal's bond sale later on, I'm joined by Uwe Parpart. He's chief economist and strategist for Asia at Cantor Fitzgerald. He's in Hong Kong. Good to see you, Uwe. So I wonder how likely a Portuguese bailout is at this stage. The Portuguese finance minister points out that it doesn't look like the market wants it to ask for one.
Well, I don't quite agree with the minister on that. If you get to a 7.6, almost 8% yield on the 10-year benchmark, you have a almost 13% yield on the Greek 10-year. So those two countries are immediate candidates for bailout. I mean, look at the doubling times. You know, if you have a 13% interest rate, you double what you borrowed by in 5.5 years. Even the Portuguese rate of around 8%, you double what you owe in less than the running time of the bonds. So this is totally unsustainable. So if they're just frankly talking nonsense when they're saying that there's no need for a bailout.
So you also think that some sort of debt restructuring or default is going to have to happen. Who's going to default first? Right. When's that process going to start to happen?
Well, we have this meeting this coming Friday in Brussels that will have to take up the currency issues, interest rate issues, and ultimately lead into the end of March decisions about the bailout facility that's been agreed, but what to do with it has not been agreed. And I think at this point in time, the most important thing that has changed is that the ECB has basically decided that it's no longer going to help out the politicians on this score. The politicians are going to have to find a way of restructuring this debt. There's no longer any ECB money to be spent to bail out the politicians' fiscal mistakes.
So what's the best that the EU could come up with then, in your opinion, at the end of March here?
Well, I think there's more and more discussion, at least on the sidelines of meetings previously, and I think this will move more to the center, that a debt restructuring is unavoidable. The market is essentially beginning to price this in very significantly. You see the CDS, the credit default swaps for Greece, at near record highs. The actual credit default swaps at Portugal also just below 500. At those levels, the market is basically telling the politicians, do something or this will, do it by itself chaotically.
Now, Uwe, this expected rate hike from the ECB, that's going to complicate the situation as well, especially in Spain, Portugal, and Ireland, where more people have variable rate mortgages that will go up.
Oh, absolutely. No, there's no question about it. But in a way, this is what the Europeans and the Americans have brought upon themselves. You flood the world with cheap money. Eventually, this will create inflation. Now that inflation is there and has to be dealt with, and at least the ECB, I must say, I would applaud by saying, okay, we're going to do something about it. The U.S. Fed seems to still think there's nothing happening, which I find, frankly, astonishing. I can't see how the U.S. can keep on going like this forever.
How does the spike in oil prices complicate the situation? Very quickly, Uwe.
Well, the spike in oil prices is also, in part at least, in the broader commodity picture, due to the quantitative easing cycles. And, of course, it makes it more complicated that you now have the political tensions in the Middle East. But from the demand-supply standpoint, I think the oil price actually should be coming back down. We'll see what happens in Libya, and hopefully Mr. Gaddafi will see the light and go. But even if not, this is not such a huge deal, and I think the oil price is less of an issue than the markets are making it out to be at this point.
Uwe Parpart of Cantor Fitzgerald, thanks very much for being with us.